So the big question about what's going to happen with interest rates. After no changes for almost 3 years, the Reserve Bank moved the cash rate in June by 25 basis points or 0.25%, and then doubled down very quickly thereafter in July with another cut of 0.25%. This was undeniably done to boost an economy that had been struggling in a number of areas, not the least with stagnant wages growth, continued low inflation, and a retail economy that had been seemingly becoming increasingly subdued. A review of over 30 banks and lenders in the Australian market suggests that these won't actually be the last rate cuts we see in the foreseeable future. Out of those published economists, 3 in 4 are predicting another rate cut of 0.25% by Christmas 2019. And 1 in 5 of those same economists are predicting a further cut again of 0.25% by Christmas 2020. If that were to occur, we would actually see the cash rate down at a previously unthinkable 0.5%. We saw some time back for owner-occupied home loan borrowers, the rates fall down through the 4% barrier. These most recent cuts have seen many rates fall close to 3% than they would be to 3.5%. And indeed, we've even seen a couple of specials out there at 2.99%. Quite simply, the lower the rates fall, the less likely it is that we'll see the banks pass on the full extent of any future rate cut by the RBA. The reason for this is quite simple. The banks take deposits from customers and investors and pay an interest rate down here. They then re-lend that money out to borrowers at a higher rate, and the difference between those two rates is their profit margin. Now, generally speaking, when rates fall, both the investment rate and the borrowing rate fall at the same time, and as you can see, their margin is maintained. The problem that the banks have got at the moment is a lot of those investment rates are already at or close to zero, so they can't go any further. What they've seen is, despite these ones having bottomed out, the borrowing rates they can charge to borrowers continues to fall. It means that their margin has shrunk quite considerably. Now, further rate cuts by the RBA will mean that there's pressure on them not to pass on those rate cuts to the borrowing customers and shrink that margin any further. Put simply, there's never been a better time to be a home loan borrower. Even if you fix now and missed out on potentially 1 or 2 rate cuts down the track, as we've pointed out, there's an argument to say that such rate cuts by the RBA may not be passed on in full, if at all, by the banking sector. So giving consideration to locking in your home loan now may make sense and good financial sense to a lot of people. As always, speak to an expert and make sure your own personal circumstances are well and truly taken into account. As always, if you've got any questions, please don't hesitate to send them through. And until next edition of Finance Friday, have a great weekend.